Most traders right now think gold is doing nothing, but that is exactly where they get trapped. Gold is currently trading around $4,749. It looks slow, it looks boring, but this is not a dead market. This is a setup. And if you understand what is happening right now, you can position yourself before the next big move. Let's break this down step by step from the monthly chart all the way down to the 15-minute chart. Starting with the bigger picture. On the monthly time frame, gold is still in a strong long-term uptrend. Over the past 2 years, gold has been making consistent higher highs. In January 2026, gold reached an all-time high near $5,595. After that, we saw a sharp correction. Price dropped aggressively toward 4,100. But here is the key point. That drop did not break the long-term structure. The trend is still intact. Major institutions are still bullish on gold. Long-term projections still point toward the 5,000 to 5,500 range. So the big picture is simple dot. So the big picture is simple dot. Gold is bullish long-term, but it is not moving in a straight line. Now let's move to the weekly time frame. This is where things get interesting. At the top, price took out liquidity above the highs. Then we saw a sharp rejection. After that, price dropped hard and reached the 4,100 zone. That move also took liquidity on the downside. So now both sides have been targeted. And what happens when that occurs? The market enters a range. Right now, gold is trading between roughly 4,100 and 4,800. This is not random movement. This is controlled behavior. And in this environment, most traders lose money. Why? Because they trade in the middle. Now let's go to the daily chart. This is where structure shifted. Earlier, the market was making higher highs, but then price broke below the 5,000 level. That was a clear shift in momentum. Now we are seeing lower highs forming. This tells us that short-term pressure is still to the downside. There is a supply zone around 5,050 to 5,150. Below there is a demand zone around 4,400 to 4,500. And deeper down there is a major liquidity zone near 4,100. Right now price is trading around 4,749. That puts it slightly below equilibrium. This is important because the middle of the range is where traps happen. Now let's zoom into the 4-hour chart. Here we see clear consolidation. Price is moving between 4,700 and 4,800. Multiple rejections on both sides, equal highs forming, equal lows forming. This is classic liquidity building, and this is where breakout traders get caught. They see a breakout, they enter early, and the market reverses. Now the 1-hour chart confirms the short-term direction. We are seeing lower highs, we are seeing lower lows. The most recent rejection happened near 4,790. That tells us buyers are still weak in the short term. Now let's go to the 15-minute chart and talk about execution. This is where things become actionable. Right now, the short-term structure is bearish. The market has already rejected higher prices. So here is the setup. Look for a short position around 4,750. Wait for confirmation. Do not enter blindly. If price shows rejection, that is your signal. Place your stop loss above 4,800. That is your invalidation level. If price breaks above that, the setup is no longer valid. Now let's talk about targets. First target is 4,706. Second target is 4,660. Third target is 4,614. Take partial profits at the first target. Then move your stop loss to break even. From that point, the trade becomes risk-free. Now let's talk about risk management. If you are trading a $10,000 account, your maximum risk per trade should be 1%. That means $100. Adjust your position size based on your stop loss distance. Never over risk. Now let's bring in the fundamentals. Because price does not move on charts alone. Right now, global tensions are rising. The situation between the US and Iran is unstable. Oil prices have pushed above $100. That increases inflation pressure. At the same time, the US dollar is getting stronger. And a strong dollar puts pressure on gold. Interest rates are also staying high. And expectations for rate cuts are decreasing. This creates a conflict. Fear supports gold. But high rates and a strong dollar push it down. That is why gold is stuck in a range. Now here is the key takeaway. The high probability scenario is this. Price may move lower first. It may take liquidity below. And then it can reverse aggressively to the upside. This is how the market traps traders. The alternate scenario is a breakout above 4,800. But without strong confirmation, that move can fail. So patience is critical. Do not trade the middle of the range. Wait for the edges. Wait for confirmation. Now I want your opinion. Do you think gold will drop first or break higher from here? Let me know in the comments. And if you want more high probability setups like this, make sure to subscribe because here we focus on logic, not